You're a young person that's coming into the industry, you're business minded, you're somebody that wants to make a mark in here. What part of the industry would you recommend that person come into?
If you don't have a fundamental or technical background, I'd probably start at the royalty side of things, looking at what Sandstorm or Cisco, Franco-Nevada, Wheaton Gold. That's kind of the easiest place to start, because these are teams that are de-risking themselves, and you know, there's guys like Rob McEwen, a good friend of mine, we were just on the panel. He doesn't like these streaming companies because they eat away at the bottom line of the mining companies. But as a shareholder, that's exactly what you want. You don't want to take any of the production risk, development risk, and that's where I would start if I was just a finance with no technical background.
Hey guys, welcome to Market Uncharted. Today, as you've seen, we are going to check a video about the gold sector. And this is important because not only on Twitter, but on all the networks that I'm seeing about the gold sector, I can see that people sometimes confuse the gold physical metal, which is no doubt a risk-free asset, the safest asset in the world, inflation hedge, preservation of wealth, but then also confuse this with the miners of gold and silver, you know, the explorers, the producers. And today what I want to clarify is that the speculation is on the miners and also the explorers and the producers. But if you really want to take advantage of gold as a safe asset with a little bit of leverage, then we definitely should be on the royalty companies and the streaming companies. And I'm going to present a few ideas about what is a royalty company, what is a streaming company, why should we be investing in it, and why these type of companies can reduce the downside risk and still take advantage of the upside if gold actually spikes up. Of course, that we need to bear in mind that if gold really goes up, the leverage and the exponential gains will always be in the explorers and the developers, the miners of gold. And of course, these royalty companies may not go the same percentage up as the others. But still, it's really important to be on the safe side, cash flow, risk-free, healthiest balance sheet possible, and of course the dividends. And I'm going to show you a few companies that I really like. So stick around and I hope you like the video.
You are a royalty company, and I'm excited to have you on because you're my only royalty interview here at the conference.
Oh, interesting.
And I wanted to ask you, given the current price environment, you know, we've seen how bullion price has outperformed gold miners, but let's look at it vis-a-vis the royalty companies.
Well, it's a fascinating question. You'd think in an efficient market that they should be priced appropriately, but over time the royalty companies have done better, haven't they? And certainly we love the royalty model, right? And so that's a loaded question from our perspective. But you'd like to see the gold miners themselves do well in a price environment where gold continues to augment, which we might see in the forthcoming year with potential weakening of the US dollar.
All right, so let's start first with defining what is a royalty company and what is the streaming company. And then we will check it out, the benefits and a few companies that I really like. So let's start. A royalty agreement is where the mining company pays the royalty holder a percentage, usually between the 1 to 3% of the value of the production of the operating profit of the mine for the life of the mine. Let's give an example. If Kirkland Gold's mine produced 200,000 ounces of gold, then Franco-Nevada will get 3% of the revenue generated from the 200,000 ounces. Assuming the spot price of gold is $1,200, that means the mine made $240 million. A 3% royalty would net Franco-Nevada $7 million. And of course, this is just to keep the math simple. We all know the gold price is way above $1,200. Then we have the streaming agreement, which this is an agreement where the mining company delivers to the stream holder a percentage, usually between 5 to 20%, of one or more of the metals produced by the mining company. So in this case, let's see, for example, Newmont Gold Corp will use the loan to develop mine A. In exchange, Wheaton Precious Metals will have a 7% interest in the mine A until 200,000 ounces of gold has been delivered by Newmont. and then receive 2% after. And this is important because let's, for example, if the deal was for 50% of the spot price, then Wheaton Precious Metals can realize a quite nice profit margin by paying Newmont Gold Corp, let's say $600 per ounce for gold, when the spot price is actually $1,200. And again, we can do this for several types of spot price when Wheaton Precious Metals buy at a discount. And this is the main difference, because then Wheaton can go to the market, sell spot, and make a really nice profit. So let's see the benefits between these royalty and streaming companies. And this is really important because they allow diversification, wide margins, and quietly reduce the risks. And this is really important again because as we try to do our best, we always want the safest asset possible, downsizing the risk, increasing our gains. And this is really important. A streaming company gets to buy the metal at reduced price, which guarantees a wide profit margin. The reduced price is significant enough that the margin will stay very profitable even if the spot price falls. Let's give an example. If Franco-Nevada is buying gold at $600 an ounce, then even if the spot price of gold declines from $1,200 an ounce to $900 an ounce, Franco-Nevada is still turning a nice profit on his gold investments. And another important part, and this is really important, is the type of costs that these companies have. We have here a comparison between Barrick Gold, Newmont Mining, and for example Wheaton Precious Metals or Franco-Nevada in terms of costs, because these royalty companies have high revenue with way less employees because they are not exploring the mines. For example, Wheaton Precious Metals, the largest royalty name with just 35 employees, at 21 million revenue per employee in the second quarter of 2019. A few risks that's also important, and also this is always connected with debt, because these companies sometimes can get debt to be able to invest on other companies, and of course with low interest rates everything is fine. But as you've seen nowadays in the world, if for example the Fed has to increase the interest rates, then it can have an impact on the debt of these royalty companies to repay their own debt. So this is really important to understand. And of course, let's just give here a quick summary of capturing the upside that these royalty companies have versus trying to do their best to reduce the risk. And this is why they are so important in the gold sector, because they provide investors a really cool downsizing of risk in this gold sector. Don't forget, royal and streaming companies are more versatile compared to miners in changing market conditions, investing in low-cost opportunities during market downturns, reaping the rewards during the market upswings. And this is my top 3 companies on this royalty sector. My favorites are of course Wheaton Precious Metals and Franco-Nevada Gold. But also, if you want a slightly less quality assets but a still strong balance sheet, Royal Gold Inc. is also a really good idea. And don't forget also precious metals area, you have gold, platinum and silver. These are the most important precious metals. It's important for us as investors to be invested in these type of assets. You can do it either, again, the physical metals itself is always important to hold a little bit of physical, or you invest in these royalty companies. So thank you guys so much for watching the video. Don't forget, knowledge is not power, knowledge is potential power, execution is everything, and just like the markets, we will not rest.